from the standpoint of we've seen how things were in the previous administration. We've seen how they are now. We know what things look like. We know that interest rates are astronomically high. Why? Because inflation was transitory, if you remember, and all of a sudden it wasn't.
That a lot.
Yeah. Well, guess what? No, inflation was real and it hasn't come down. And the Fed is looking at things and saying, hey, like our next move it's not going to be a hike.
You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. This is Financial Survival Network. I'm your host, Kerry Lutz. Hey, we're almost in mid-May. We're getting all sorts of interesting readings. Consumer confidence, or lack thereof, came out today. Eddy Gifford is with us from Tactive Wealth. Eddy, great to have you back on. So what do we make of the consumer confidence numbers?
Well, I think it tells a tale of what they're telling us versus what people are feeling. We had a pretty significant drop from 77.2 to 67.4 over the last month. The lowest it's ever been is 50. That was actually in June of 2022. So people are concerned. Of course, when you look at what the big guys are telling us, they're saying, oh, everything's fine, markets are up, everything's going good. And maybe that helps when you look at your portfolio this month. But when you look forward and you ask people, how do you think things are going to be in 3, 4, 5, 6 months? People are saying that they're worried, they're concerned. There's obviously a lot of stuff going on right now that they can and probably should be worried about. So we just have this huge disconnect between what they're saying and what the data is actually telling us.
Right. So what is it they're really saying? I mean, obviously they want to make it look as good as it can possibly be, but that old saying, you can fool some of the people some of the time, some of the people all of the time, but you can't fool all of the people all of the time. I mean, they could have been talking about gaslighting, right?
Of course. I mean, the beautiful thing and the unfortunate thing about numbers is you can pretty much make them say anything you want them to say. So if they want the data to say something a certain way, then they'll massage the data so that it says it that certain way. And everyone's leaning on the fact that the stock market is up, and that's true. I mean, if you account for inflation over the last 3 years, then we still haven't eclipsed the inflation-adjusted tops that we hit in 2021. So you could argue that we haven't actually broken out into real new highs yet. And then when you just look at it from the other side of the coin, you've got a lot of people that have been having to take second and third jobs just to keep up with this stacking inflation. Everyone keeps telling us inflation is coming down. It's not coming down. It's slowing. There's a big difference there. We're not seeing, deflation. We're seeing we're seeing the growth slow in inflation, but that doesn't help the fact that it already stacks 2021 and 2022 on top of each other. So people are looking in the mirror, trying to figure out, how do I pay for groceries that are 30, 40, 50% more expensive than they were 3 years ago? And that's the thing that I think is coming through in the consumer sentiment report is that, everyone tells us that things are good and they're fine. But when you actually look at your bank account, when you actually look at your receipts, you're like, wait a minute, inflation hasn't come down. I'm still paying way more than I used to. And it's starting to, I think, make people angry, and hopefully we don't have an angry mom upon us, but there are a lot of people that are not happy right now.
Yeah, it seems like mostly everyone isn't happy, because if you look at the number of people who are happy with the current administration, that number has cratered. According to Martin Armstrong, the satisfaction rate with the current admin is 8%. Unlike the 36% there, the approval rating is in the tank here. And, whether you care about the politics or not, the thing is that it really is a commentary, a very sad commentary on what's going on in the country.
Yeah, when you look at what's going on, and you just, I mean, the reality is that we've seen both sides of the coin. From the standpoint of, we've seen how things were in the previous administration, we've seen how they are now. We know what things look like. We know that interest rates are astronomically high. Why? Because inflation was transitory, if you remember, and all of a sudden
it wasn't. That a lot.
Yeah. And well, guess what? No, inflation was real and it hasn't come down. And the Fed is looking at things and saying, hey, you know, like, our next move is it's not going to be a hike. It's not going to be a hike. So that kind of settled the markets a little bit. The Fed backed off and on their tapering. And so like that kind of increased liquidity. And so it's very hard not to look at all of this and say, hey, this is just one big plan to keep liquidity going through the election cycle so that we can watch markets climb, and we can say the stock market was up, and when in reality, the stock market is not up after you account for inflation. And so it's funny that this year we've talked about all these like, oh, we're hitting new highs. We're hitting new highs. In the previous administration, we were hitting new highs every day for like 4 years straight. Like that doesn't really matter. The fact that it's taken 4 years to hit a new high, that's the thing that we should be concerned about.
Yeah, we should be very concerned, because the stock market's less a function of the actual economy and more of the state of the market, right?
Exactly. And when we get to these new highs and people start getting concerned, and we see like that FOMO kick in where people are running and putting money in, unfortunately, a lot of times that serves as exit liquidity for the people that are like, hey, we're watching gold. Gold is outperforming. Hey, we're watching utilities. Utilities are outperforming. They know that historically those are risk off metrics. And so as people are piling in because they're afraid to miss out, the big money, so to speak, is kind of like just taking gains off the table. And when things collapse, because they will, and I don't know if it's going to happen this year, if it's happened 2 years, 3 years, or whenever, but you can only push the can or kick the can down the road so many times. You can only build the house of cards so far. And unfortunately, we're in this scenario where since 2009, we've pretty much been at zero interest rates. It's caused this massive spike in U.S. stock markets, almost parabolic in a way, and those things never end well. So it's one of those things where you can't afford not to be invested, but at the same time, you can't afford to play the buy and hold game right now. In my opinion, it's one of those things that could really bite you. Okay,
so we can't do that. What can we do? What's the best way to go about this here?
Well, I think it's two things. One, you could have more of a trader's mentality from the standpoint of anytime that you buy something, you have to have a great reason to get out, whether that's a profit target or a stop or something, or you just have to make sure that your portfolio actually has true insulation in it. And unfortunately, that's probably not bonds, especially if we continue to have an inflationary type environment. We look at 2022 and that your traditional 60-40 was down just as much as 100% equities. I'd rather have all the risk and all the potential return than be in a situation where I'm still going to get the same amount of loss and I'm supposed to be taking half the risk. So we're looking a lot at alts. So that might be commodities like precious metals, that might be managed futures. But we're paying attention to the types of things that typically do well in inflationary environments. We like the idea of managed futures because they're typically trend following, so you don't have to figure out like what to pick. And if you look at 2022 as a proxy, those were up 30, 40, 50% that year. So they actually provided insulation where bonds didn't. So I think that probably a combination of both have some type of like hedge or insulation in place that works regardless of the interest rate environment. And then have exits in place. It's okay to take profits on the way up. It's okay to take to just lock in a loss on the way down. You don't have to ride that roller coaster all the way down. And you'll be happy that you didn't when you get to the other side and a lot of stuff's on sale. So be disciplined, have a plan, follow your plan. And if you can't figure it out yourself, then talk to somebody with that mentality.
All right. What about, we haven't talked about the so-called fear trade, which now is obviously precious metals, Bitcoin, cryptos. What's your feeling there?
I still like the cryptocurrencies, and I still like gold. Even silver is a way to kind of play gold from like more of a leverage standpoint. Gold has broken through, resistance. It kind of ran, it pulled back a little bit. Gold is becoming the reserve currency for other nations. So you would think that that's going to cause demand, and obviously more demand should cause prices to elevate. And the other side of the coin is you've got Bitcoin and cryptocurrencies. I would lean more on Bitcoin than anything else. I think the other stuff is more speculative because of all the big guys, so to speak, getting involved in the Bitcoin space. I think that it becomes safer, not safe, safer. Still a very, very volatile asset class, but it's, I think that the good thing and the bad thing about it is it's kind of built on mistrust. So if you don't trust the government, if you don't trust this, if you don't trust that, well, we should put our money into Bitcoin because, it'll keep our money safe, so to speak. I don't know if that's a good recipe for long-term anything, but what we've seen is the high inflationary companies are leaning into countries are leaning into Bitcoin. We're seeing the big wigs like Morgan Stanley and BlackRock. They're actually filing to include the Bitcoin in some of their flagship strategies. And so to think that like demand is going down in the Bitcoin space, again, like we don't see that, especially since we're on the back half of the halving and we're not producing as much Bitcoin anymore. I think both of those, gold and Bitcoin, become a very good like supply and demand story. Is it a hedge against anything? I think it's a hedge against like mistrust. But I think that the supply demand story is the bigger story there, where we could actually see things really, really ride in both places. Probably the 40 and unders are going to own the Bitcoin, and the 40 plussers are going to own the gold.
Okay. All right. Well, so if gold's going up, then silver is going to eventually go up as well, won't it?
Yeah. I mean, the precious metals are generally going to track, but gold and silver have a very, very close relationship. And so usually when one goes up, the other one follows, and usually it's gold first, silver second. So silver isn't a bad way to play the rise in gold. And of course, there's a lot of other precious metals out there like copper, for example, that could serve as a really, really good, store of value. I mean, it's very volatile, just like any other commodity, sure. But you've got like both sides of the fence, where you've got like the green world and the other side, and like they both need copper. And so, to think that like, and those are the reasons when you look at it, you're like, to think that inflation is going to go down, like all of these things, the prices are going to continue going up. And that's scary, because I think 2022 might have just been a taste, not the real thing.
Think so, huh? Wow. So we got interesting times ahead here, don't we, Eddy?
We definitely have interesting times. Doesn't mean you got to run and stick your head under, in the sand or go lock the door and don't come out for 4 years. But it does mean that you should have a plan that's flexible and nimble and can take advantage of some of these things. Unfortunately, a lot of places, they only allow you to do stocks and bonds. Like for you not to have precious metals and managed futures and potentially Bitcoin in your portfolio, I think that's a mistake.
I agree. All right. Hey, really appreciate you coming on, Eddy. Just tell us again where we find you these days.
Yeah, definitely. Tactivewealth.com/Eddy-Gifford. Of course, you can always go online and Google me. It's Eddy Gifford, Eddy with a Y, Gifford, and you'll see probably this that we're talking about today show up in a day or two on that on the search engine. But we're here to help. We know that it's scary times, and we don't have any quotas or anything. We're independent. We work for our clients, and if Bitcoin makes sense, we have Bitcoin. If managed futures make sense, we use managed futures. So you have the flexibility and to pretty much go anywhere if you're working with us.
All right. Hey, we like that about you, Eddy. You're always there for the customer. You don't have an agenda. And got a question for Eddy or myself. KL@kerrylutz.com is the email to send it to. And The link to Eddy's site, you'll find it in the show notes to this interview on financialsurvivalnetwork.com. And while you're there, please sign up for your free newsletter. Eddy, always a pleasure. Thanks for stopping by.
Thank you for having me.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.